Welcome to SafeSimpleSound Financial Planning Podcast. I am Fani Kandula and this is episode 6-7. If you don't know that reference, it's for my children. And hi guys, they are going to watch this show later. In today's episode, we are going to do something little different. Instead of just explaining whole life insurance, I'm going to teach you a systematic thinking capability called pattern extraction. It's one of the 4 moves from my book, Your 4 Moves. And we are going to practice it using whole life insurance as our example. Now, if you have ever felt confused about whole life insurance, you are not alone. And here is what's interesting. The confusion isn't actually about insurance itself. It's about how we are thinking about it. Let me paint a picture you have probably experienced. Maybe your financial advisor suggests whole life for tax-advantaged savings. Then an insurance agent pitches it as retirement income supplement. Your estate planner mentions it for liquidity at death. Meanwhile, your investment advisor wants it's expensive and complex, and that personal finance guru you follow online calls it a scam compared to buy term and invest the difference. And the result? It's overwhelming, contradictory opinions, no clear understanding, either paralysis or poor decisions based on whoever voice is the loudest. But here is what I have discovered working with many families. The problem isn't that whole life is confusing. The problem is we are trying to memorize features and pick sides in a debate when what we really need to do is extract the patterns that help us understand when and why whole life might serve our specific situation. So today, instead of adding one more opinion to the pile, I'm going to teach you pattern extraction, the systematic thinking tool that makes complex financial topics manageable. And here is the cool part. Once you learn this, it doesn't just help with whole life insurance, it works for every complex financial decision you will ever face. And honestly, it works beyond finance too. Career decisions, health choices, life planning. But let's start with whole life. Ready? Let's dive in. Alright, let's extract our first pattern. This is a universal principle that shows up everywhere in finance, and once you see it, you can't unsee it. Here is the pattern. Some financial vehicles serve one purpose exceptionally well. We'll call these specialized tools. Others serve multiple purposes adequately. These are integrated tools. And here is the key insight. Neither is better. They serve different strategic needs. Let me give you some examples so this becomes concrete. Specialized tools. These do one thing really well. Think about a 529 plan. It's designed for education funding, period. Or a HSA, healthcare expenses only, term life insurance, pure death benefit protection. These tools are like chef's knife, incredibly good at one specific job. Integrated tools. These serve multiple purposes. A brokerage account gives you investing capability, but also liquidity and flexibility. You can access it, move money around, use it for various goals. It's more like a Swiss Army knife, not the absolute best at every single function, but useful across multiple situations. Now here is where whole life insurance fits into this pattern. Whole life is a multi-purpose financial tool. It provides death benefit protection. That's the primary purpose. But it's always there. It also accumulates cash value as a secondary financial feature. It offers tax-advantaged growth environment. Your cash value grows tax-deferred, and death benefit is generally tax-free. You get liquidity through loans and withdrawals, strategic flexibility when you need it, and it has guaranteed values, the certainty component. And this is why opinions about whole life differ so dramatically. People are evaluating it through single-purpose lenses. They are asking, is this the best investment? Or is this the cheapest insurance? But those questions miss the point. You won't evaluate a Swiss Army knife by asking, is this the best knife? The value is in the integration, not in maximizing any single feature. Now here is where pattern extraction becomes powerful. This specialized versus integration pattern transfers everywhere. In your career, you might be a deep specialist or a versatile generalist. In business, you might run a focused niche or diversified offerings. In relationships, you might have intense connection with few people or a broad network. Neither is always better. Context determines value. And that's what pattern extraction teaches you, to recognize when each approach serves your situation best. We are not memorizing whole life good or whole life bad. We are understanding the pattern so that we can evaluate it intelligently. Let's pause for a second. Can you already see how this pattern shows up in other areas of your financial life? Maybe you're already thinking about how this applies to something else you're evaluating. That's pattern extraction at work. Okay, let's extract our second pattern. This one is really powerful because once you understand it, you can evaluate any financial asset systematically. Here is the universal principle. Every financial asset involves trade-offs between three characteristics: growth potential, how much can you earn, access flexibility, how easily can I use it, and outcome certainty, how predictable are the results. Now, here is a crucial insight. You can't maximize all three simultaneously. High growth requires accepting uncertainty. Maximum certainty limits growth. Complete access often means sacrificing some optimization. It's always a trade off. Now, let's make this concrete with some examples. Savings account, low growth, but high access and high certainty. You can get your money anytime, and you know exactly what you will have. The stock market, high growth potential but low certainty. You don't know what it will be worth when you need it. Medium access, because you can sell, but timing matters. Real estate, medium growth potential but low access. It's illiquid. You can't just pull off your house value on a Tuesday. Bonds, low to medium growth, medium access, high certainty. Now, where does whole life fit? Whole life prioritizes certainty and access over maximum growth. You get guaranteed cash values. You know the floor. Guaranteed death benefit. Your family knows what they are getting. Guaranteed premiums. No surprise increases. For access, you can borrow against the cash value without selling anything. The loans are flexible. But for growth, it's moderate. You get dividends plus guarantees. But you are not going to beat stock market over time. And that's the trade-off. And this explains whole life debate perfectly. Critics compare it to stocks, pure growth vehicles, and of course, it loses in that comparison. You can't maximize growth and certainty simultaneously. Advocates compare it to bonds or savings, certainty plus moderate growth, and it's competitive in that comparison. But both sides miss the point. Whole life is about balance across all the three factors, not maximizing one. Now let's make this pattern even more useful. This growth, access, certainty triangle is fundamental to all financial decisions. Your emergency fund, you're prioritizing access and certainty over growth. You need that money available and be predictable, even if it doesn't grow much. Retirement accounts, you're prioritizing growth and sacrificing access. That's why there are penalties before age 59 and a half. Real estate in your portfolio, you are accepting low access for growth potential and some inflation protection. Once you understand this pattern, you can evaluate any financial vehicle by asking which corners of this triangle does this prioritize, and then ask which corners do I need this specific money to prioritize. That's pattern extraction. We are not memorizing features. We are understanding the underlying structure that makes intelligent evaluation possible. Our third pattern. This one might be the most important one because it resolves what seems like impossible choices. Here is the universal principle. Complex financial goals rarely have single solution answers. Instead, successful strategies layer multiple tools where each tool serves specific aspects of the complete need. Let me give you some examples you will recognize immediately. Retirement income. Successful retirees don't just rely on one source. They layer social security plus pension plus 401k distributions plus IRA withdrawals plus maybe some taxable account proceeds. Multiple sources create flexibility. If one source has an issue, the others are still there. Emergency funds. Smart people layer savings account for immediate access, maybe a HELOC for larger emergencies, and a brokerage account for severe situations. Different urgency levels, different access points. Education funding. You might use 529 plans plus savings plus current income plus financial aid. Multiple paths reduce risk. Now here is where whole life fits into this pattern. Whole life works best as one layer in a multi-strategy approach. And this completely reframes the whole buy term and invest the difference versus whole life debate. The debate is a false binary. The real question isn't which one. The real question is which layers do I need? Let me show you what strategic layering might look like. Layer 1, term life insurance. Maximum protection, minimum cost. This covers young family needs when your income is most critical and you might not have accumulated much wealth yet. Layer 2, whole life. Permanent protection plus financial features. This might serve estate planning needs or business succession funding. Layer 3, your 401k and IRA. Maximum retirement growth with tax advantages. Layer 4, emergency fund. Immediate access for unexpected expenses. Layer 5, taxable investment account. Growth plus flexibility for goals that don't fit neatly into other categories. Now here is what makes this approach powerful. Each layer serves different purposes. Some years you fund layer 1 heavily, maybe when you have young kids at home. Other years you maximize layer 3 Maybe when your income spikes, sometimes you access layer 2 for a strategic opportunity. The system creates resilience because no single layer has to do everything. And notice, what does this do to our thinking? We are not asking, is whole life good or bad? We are asking, what role, if any, does whole life play in my complete strategy? What gaps does it fill? How does it complement my other layers? Now, this strategic layering pattern transfers beyond finance. In your career, you might have a layer, a full-time job, plus side project, plus volunteer work, multiple income and fulfillment streams. For health, you layer nutrition plus exercise plus sleep plus stress management. Comprehensive wellness, not a single best solution. Relationships, you have your partner, your family, your friends, your colleagues. Each serves different needs. You are not trying to get everything from one person. So when you are facing apparent either or choices in any area of life, pattern extraction teaches you to ask, how can I layer approaches that each contribute to the complete solution? That's our third pattern. And notice what we have done here. We have not memorized features of whole life insurance. We have extracted three universal patterns that help us think systematically about complex decisions. Let's take a breath. We are about halfway through. You have just learned three patterns that make financial complexity manageable. Next, we are going to apply these patterns to your specific situation so you can actually use this framework. Now let's get personal. Let's apply these patterns to your specific situation. This is where pattern extraction moves from theory to practical decision making. Let's start with pattern 1, the multi-purpose versus specialized tools question. Here are some situations that suggest whole life might have value for you as a multi-purpose tool. You have estate tax concerns and you need both permanent coverage and liquidity. You are a business owner and you need life insurance plus funding for business succession planning. You are a high earner who is already maxing out traditional tax advantaged accounts and you want additional tax preferred saving space. You want retirement income supplement, but you also want to do that with death benefit protection, not instead of it. Or you just value certainty and guarantees over maximum growth potential, and that's a legitimate personal priority. On the flip side, here are situations suggesting that specialized tools might serve you better. You need maximum death benefit for minimum cost. Term life insurance specializes in that. You want maximum investment growth. Stock market specializes in that. You are early in your career with a tight budget. Term plus investing the difference might make more sense right now. Or your insurance need is temporary. Maybe you need coverage until your kids are through college. Thus, term life specialty. So, here is your assessment question for pattern 1. Do I have financial needs that would benefit from an integrated tool, which is whole life strength? Or am I better served by specialized tools doing one single job exceptionally well? There is no universally right answer. It depends on your specific situation, your priorities, and where you are in your financial journey. Now, let's apply pattern 2. The growth, access, certainty triangle. Here is how to think about this. If you prioritize certainty, guaranteed values matter more to you than maximum potential. Predictable premiums are more important than lower costs that might actually increase. Having a minimum floor is important for your peace of mind. If this sounds like you, whole life certainty features align with your values. If you prioritize growth, you are willing to accept uncertainty for higher potential. You have a long time horizon and you can tolerate market volatility. Maximizing dollar growth is your primary objective. If that sounds like you, stock market investments serve you better than whole life for this particular money. If you prioritize access, you need flexibility to access funds without penalties. You value optionality over optimization. You want liquidity without being forced to sell at a bad time. If that sounds like you, whole life's loan features plus taxable accounts work really well. But here is the sophisticated question. What combination of growth, access, and certainty does your complete financial situation need? And where does whole life's particular balance of all three serve that combination? Because remember, different money has different jobs. Your emergency fund needs access and certainty. Your retirement accounts can prioritize growth. Some money might need the balance that whole life provides. So here is your assessment question for pattern 2. For this specific money, the amount you would potentially put in a whole life policy, do you need guaranteed floor? Can you accept lower growth in exchange for certainty? Do you need access flexibility without disrupting your wealth? Would you sleep better at night knowing the guaranteed values? If your answers trend towards yes, whole life's balance might align with what you need for this particular portion of your overall strategy. Okay, let's apply pattern 3, the strategic layering analysis. This is where we look at your complete financial picture. Here are the questions to ask. How does whole life fit into your complete financial strategy? Not in isolation, but as part of the whole system. What other layers do you have in place? What gaps does whole life fill that your existing layers don't cover? Are these layers complementary, meaning they strengthen each other, or redundant, meaning they duplicate functions? And does adding whole life as a layer create resilience, or does it add unnecessary complexity? Let me walk you through how to exactly do this layer check. First, do you have adequate term life insurance? That's your protection layer. If you don't have enough basic coverage yet, that's probably your starting point, not whole life. Second, are you maximizing your 401k and IRA contributions? That's your retirement growth layer. If you are not maximizing those yet, you generally want to prioritize them first because they offer better tax advantages for pure accumulation. Third, do you have a solid emergency fund? That's your access layer for unexpected expenses. You need this foundation before adding more complex layers. Once those foundations are solid, then you ask what's missing that whole life specifically addresses. Maybe it's permanent coverage that term life doesn't provide. Maybe it's additional tax advantage space beyond qualified retirement accounts. Maybe it's the unique combination of access plus certainty plus death benefit that no other tool provides quite the same way. And here is your integration test. Does adding whole life strengthen weak areas in your strategy, or does it duplicate what you already have well covered? That is strategic layering in action. You're not asking, is whole life good? You're asking, what role does whole life play in my complete system? Okay, let me give you a quick framework to summarize when whole life likely makes sense versus when alternatives are likely better. Whole life likely makes sense when you need permanent death benefit, not just term coverage. You value certainty and guarantees over maximum growth. You have maxed out traditional tax advantaged retirement accounts. You have estate planning needs like liquidity for estate taxes or business succession. You are a high income professional or a business owner who wants additional tax preferred savings. You are building strategic layers, and whole life fills specific gaps others don't cover. And importantly, you understand and will actually use the multi-purpose features. Don't buy it for just one feature. Alternatives are likely better when your insurance need is temporary. You are prioritizing maximum investment growth. You haven't maxed out your 401k or IRA yet. Do that first. It offers better tax advantages. You can't afford adequate coverage with whole life. Term provides more protection per dollar. You need complete liquidity without any restrictions. You are early in your career with a tight budget. Build your foundation first, or you just don't value the certainty features enough to accept the moderate growth trade-off. Again, these are not absolute rules. They are guidelines based on the patterns we have extracted. Your specific situation determines which path makes more sense for you. Here is what's really cool about what we just did. You didn't just learn about whole life insurance. You learned something much more valuable. Let me walk you through what you have actually learned today because it goes way beyond insurance. You have learned pattern extraction process. First, extract patterns from complexity. We found multi-purpose tools, the growth axis certainty triangle, and strategic layering. Second, apply these patterns to your specific situation. We've mapped your needs to the pattern implications. Third, we build a personal decision framework. You now have a reusable evaluation framework. Now watch how this transfers to unlimited financial decisions. Evaluating 401k versus IRA versus taxable accounts. The same three patterns apply. Multi-purpose versus specialized. What corners of the growth access certainty triangle matter for this money? How does this layer with your other accounts? Choosing between paying off your mortgage, keeping it, or investing the difference. Same patterns. What certainty do you need? What access flexibility do you want? How does this layer with your other financial goals? Deciding on traditional versus Roth conversions, pattern extraction shows you the path. Tax certainty now or later. How does this layer with your overall tax strategy? Building your investment portfolio, strategic layering creates resilience. You don't need to find the single best investment. You need a layered system where each part serves a specific purpose. But here is where it gets even more interesting. This transfers beyond finance. Career decisions. Should you be a multi-purpose journalist with diverse skills or a deep specialist? Pattern 1 helps you think about that. Health choices. Are you prioritizing growth and performance, convenience and access, or safety and certainty? Pattern 2 applies directly. Life planning. How do you layer work, relationships, personal growth, and the rest into a sustainable system? Pattern 3 gives you the framework. And here is the ultimate value of pattern extraction. You didn't just learn about whole life insurance. You learned how to extract patterns from complexity, apply those patterns to your situation, and build decision frameworks that work across unlimited contexts. This is your four moves pattern extraction in action. You are finding the universal principles underneath specific details. You are creating reusable wisdom, not disposable facts. So let me give you some next steps to make this practical. For immediate application, let's talk about 5 use cases for whole life: tax management, emergency fund enhancement, parking idle cash, managing sequence of returns risk, and retirement income supplement. Now apply these 3 patterns we extracted. Does whole life provide you the multi-purpose value here? How does it fit on your growth access certainty triangle? Does it make sense as a strategic layer in your complete system? Then use the decision framework we built and run through these evaluation questions. Make your informed choices not because I told you what's best, but because you understand the patterns and you can evaluate your own specific situation. For developing your systematic thinking capability, practice pattern extraction on the next financial topic you encounter. What are the 2 or 3 core patterns underneath the details? Start building your pattern library. Notice when the same patterns appear in different contexts. And here is a powerful learning technique. Teach someone else using pattern extraction. Explaining the patterns to other person solidifies your own understanding. And here is how this integrates with your 4 moves patterns. Pattern extraction is one of the 4 systematic thinking moves. As you master it, you will naturally integrate it with the other 3 parallel tracks. That's holding multiple opinions simultaneously without premature choice. Forward time travel, projecting decisions into future scenarios to see where they lead. Backward time travel, tracing current situations back to the root causes. Complete your 4 moves mastery enables systematic thinking across all life's domain. I teach pattern extraction through financial planning because that's my expertise area. But the thinking system works everywhere. Let me point you towards some resources for going deeper. For whole life insurance specifically, if you want to explore more, look into dividend paying whole life versus non-dividend policies. There are meaningful differences. Compare whole life versus universal life versus variable universal life, and notice that the same patterns we extracted today apply to evaluating those options too. And if you are interested in strategic uses of whole life cash value, research bank on yourself concepts or infinite banking. There are some sophisticated strategies there if this tool fits your situation. For pattern extraction mastery, read my book, Your 4 Moves, Upgrade Your Mental Operating System. It's the full framework for systematic thinking. Practice pattern extraction on these financial topics, real estate, investing, tax strategies, and start noticing when you automatically extract patterns from complex new information. That's when you know you're becoming a natural thinking capability. And start noticing when you automatically extract patterns from complex new information. That's when you know it's becoming a natural thinking capability. All right, let's bring this home. Let me summarize what you now understand that you didn't understand just a few minutes ago. 1. Whole life insurance is a multi-purpose tool, and it balances death benefit protection, cash value accumulation, tax advantages, liquidity access, and certainty guarantees. It's not trying to maximize any single feature. It's offering a specific balance across multiple dimensions. 2. Whole life insurance prioritizes certainty and access over maximum growth. It's a different tool for different priorities. That's not a weakness, it's a design feature. Whether that design serves you depends on what you need this particular money to do. 3. Strategic layering resolves the false whole life versus term and investor difference binary. The sophisticated question isn't which one, it's what layers do you need and how do they work together. 4. Those 5 use cases I mentioned earlier, tax management, emergency fund, parking cash, sequence risk, retirement income, they align with whole life's multi-purpose nature if strategic layering makes sense for your complete situation. It's not a universal yes or no. That's a here is the framework to evaluate it intelligently. And 5, this pattern extraction systematic thinking that we just practiced today creates a reusable decision framework that works far beyond insurance. Every complex financial topic you encounter from now on becomes an opportunity to practice pattern extraction. Now let me close with the constitutional SafeSimpleSound wisdom that underlines everything we do. Safe. Understanding patterns reduces financial anxiety. When you know how to think about complexity, it creates psychological safety. You are not overwhelmed by details because you can extract the principles that makes those details manageable. Simple. Three core patterns make complexity manageable without overwhelming details. We didn't cover every feature of whole life insurance. We extracted three patterns that organize everything you need to know for intelligent decision making. Sound. Complete financial strategy uses strategic layering, not a single best solution. This is wisdom. We are not looking for that one perfect tool. We are building a resilient system where each layer serves a specific purpose. And here is the achievement we accomplished today. You learned about whole life insurance and you learned systematic thinking. Every complex financial topic you encounter from now on becomes an opportunity to practice pattern extraction. This is constitutional financial education. We are building transferable lifetime capability, not providing disposable product information. That's the difference between teaching you what to think and teaching you how to think. I can't tell you whether whole life is right for your specific situation. That depends on the factors only you know. But I can teach you pattern extraction so you can evaluate it systematically. And that's more valuable because now you have a thinking capability that works for every financial decision you will ever make. Thanks for investing your time in learning systematic thinking with me today. If you found this valuable, I would encourage you to check out my book, Your 4 Moves. And if you want to explore how pattern extraction applies to your specific financial situation, that's exactly what we do at SafeSimpleSound Financial Planning. We teach you systematic thinking through financial planning expertise. So you're not just getting advice, you're developing decision-making capability. Until next time, this is Fani Kandula reminding you that the best financial planning teaches you how to think, not what to think.